You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome to the show, Tim.
Jim, thanks once again for having me.
Some interesting times on the equity markets. What's happening with the Dow, the S&P?
I think they're in cardiac arrest. No, they're, it's not good. We had a rally last week, but when you look at the internals, it just wasn't a healthy rally. It was on vapor. And, I think what we're seeing is, in my work, we're seeing the process is unfolding with the topping of the 4-year cycle. I mean, it's that simple. It's a matter of how long and drawn out the topping process is. And then once it is solidified, and when I say solidified, I'm referring to the structure. Once the DNA markers are all in place and the structure is there and it's done, it's done. And at that point, it's broken. There's nothing they can do. It's going to be fulfilled at that point. And that's what we're waiting on is for, that solidification. Mm-hmm. And we're in the process. And like I said, I don't know if that takes a few days, a few weeks, or a few months. It's just a matter of how successful, I guess, they are at saving it again and again and again, or not. Is the Fed
trying to manipulate the market to keep it rising?
I think so. I think that's an ongoing process. And, I've seen, starting in 2014, the market started to get in some trouble. Not all of the DNA markers were in place. Actually, I don't even think any of them were, but we started seeing some unusual cyclical behavior at that point. And when you see something unusual, there's generally something behind it, and that's not excuses. I mean, it is what it is. It's very unusual. And even this year, there's been some controversy. In my mind, I haven't been able to determine because of the lack of structure, because, if you look at the chart, it's just been flatlined since December. And it's been hard to determine where the intermediate term cycle low was. Was it in February or was it in March? And some of those things have clarified now, which gives us some insight on where we're at. But what I'm saying is that with all of the interference, yes, it's caused some unusual cyclical behavior and twisting and distorting of the cycles, but they're still there. And that is the structure, like I said, that will ultimately solidify the deal.
One analyst told me that the institutions are bailing out on Wall Street, but they're suckering what they call dumb money to replace them, so it still looks like the markets are, if not increasing, staying flat.
And that makes sense with what I'm seeing because the internals are poor. Like I said, the rally last week was on vapor. And, the average person, they look at price and they think, well, if the price is still here and things are okay, then it's okay. And that's as far as they can see or maybe think, but, it's not. And like I said, I maintain that once we get the setup firmly in place, that, hell's coming to town. And, I know there's a lot of people talking gloom and doom. I have been saying that this is a bear market rally since '09. And I've said that it's going to continue to rally until the setup's in place. So, and I'm saying it based on hard statistics that go back to 1896 with the averages. So, I feel like I'm justified in saying what I'm saying. I think some people they can see it, but they see it for different reasons, for fundamental reasons, just observation. I'm seeing it based on some statistics and cycles and historical behavior. But I think the '09 low goes. I think we have one heck of a show once this thing is set up.
What do you think is going to be the first thing to crack here and start to collapse? Will it be all at once, or did the big drop in oil show us what's going to happen to the equity markets?
Well, I don't necessarily look at the markets. and a hard correlation, more of a soft correlation, if you will. And so let me see if I can address that this way and see if this makes sense. If you go back and look at charts and try to draw this in everybody's mind, equities, let's go back to 07 real quick. Equities peaked in 07. Housing peaked in 05, 06. Commodities peaked in 08. Everything came down together into late 08, early 09. And when I say late 08, some of the commodities peaked in like December of 8. We all know equities peaked in bottomed in late 08, like December commodities. And then in early 09, equities bottomed. And from those lows, everything rallied together. Equities, housing recovered, commodities recovered, and gold did move to a new high into the 11 top, which was a 9-year cycle top. But other than gold and all of the other commodities and asset prices, besides equities, have failed. And if you look at gold, if you look at crude oil, it peaked back in 13, and we had the signals on that, and like I said, to set up the DNA markers and so forth with the CRB and everything. And so those were all counter trend bounces, if you will. And they've proven to be counter trend bounces, and they've rolled over hard. They've done exactly what they should have done. The reason that the counter trend bounce in equities was fueled to a new high is because of all the things the Fed's done. Look what they've done. My God, QE, what? Basically infinity, and they've thrown everything at the kitchen sink at it, and that pushed that counter trend bounce to a new high and has masked in turn the underlying I don't know how to say it, depression, basically. Or recession. The economic depression. Look at the state of the economy. I know people look around and on the surface it appears to be fine, but if you look at, like I said, the job participation rate, if you look at velocity of money and all that stuff, it's just collapsed. And so someone can try to tell me that everything is fine, but I'm not buying the story. I'm looking at the data. It's not. But anyway, the attack or the assault on equities to push them higher has masked all this stuff. And everything else has rolled over, and crude oil included. More recently, we had a counter trend bounce out of a March low that is now, has rolled over. And I think equities is next. I don't know if that makes sense or answers the question, but one by one, we're seeing this stuff roll over and weaken and out of these counter trend bounces. And now equities is trying to roll over as well. And so the answer is, I think it all goes down together again, just like it did in 08 and 09.
We'll have more with Tim Wood right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's happening with gold? We've seen some big drops and it's below 1,100.
Jim, it's doing exactly what it should be doing. Some people say that, it's I don't know, doing what it's doing for other reasons. But to me, looking at gold, the 9-year cycle peaked in 2011. And I've said ever since that peak was identified in 2011 that every seasonal and intermediate term advance should be a failure and should be followed by lower prices. And that is exactly what has happened. And this one is no exception. At present, we're moving into an intermediate degree low. More specifically, as we got a low, let me pull up my gold chart. Back in early as the 8th of July, we had a little short-term low. It didn't last but a day, but cyclically that was the low, and it rolled over very, very quickly. But I said then in the short-term updates that should not have been the higher degree intermediate term cycle low, and that there should be another short-term cycle down, which, lasted about a month before that intermediate degree low was made, because the intermediate degree cycle was left translated, which meant that it should take out the previous intermediate degree low, which had occurred back in March. And as of that early July 7th, 8th, whatever it was, low, that had not occurred. And true to the statistical expectation, gold had one more push down into, this additional trading cycle. And now I think gold, we violated not only that low, but the November low, which proves that the seasonal cycle, annual cycle, was also left translated. Exactly like what I said, exactly what you would expect with a 9-year cycle top, that all of this, after that top was identified, that all seasonal and intermediate term cycle advances should be failed advances and followed by lower prices. And so what I'm saying is that this last week we have seen both the previous intermediate term and the previous seasonal cycle low violated. The previous intermediate term cycle low was in March. The previous seasonal cycle low was in November. Both have been violated exactly like one would expect based on the structure. At present, shorter term, we're pushing into, or approaching, I should say, an intermediate degree low, and we're going to get another bounce. And we get the bounce, and everybody's going to get excited about it again, just like they did coming out of the March low, and we'll start to see stuff about, how, gold's finally made its bottom. And no, it's going to be another failure that is followed by more weakness until we get into that 9-year cycle low. And, that's still something that's ahead of us. So short term, we're starting to get to a bottom, but it's going to end with another counter trend bounce.
What's the story on crude oil?
Pretty much the same. When crude oil broke, hard last fall, I said that I had longer term projections based on statistics. This should take crude oil back, into the 30s, if not lower. And, we correctly identified, you get the letter, I think you know that, the intermediate term low in March. And I said that it'd be a multi-month rally. We know that the cycles as well as the seasonality lined up. We know that typically you have lows in the January to March, April time frame, and then you have highs that typically occur in the June, July, August time frame and tend to coincide with the summer driving season. And that's exactly what has happened. Crude oil has rolled over. The multi-month rally out of the intermediate term low has pretty much run its course. And now, I think crude oil, the longer term downtrend has resumed. Structurally, the March low is key. Once it's pierced, we're on our way, and I really think it will be pierced, but we're on our way, into the 30s, I believe, with crude oil.
A lot of people expected that with lower oil prices, the economy might improve because consumers would have more dollars in their pockets, but those numbers never did come up.
No, and that, I don't see how, if the economy is that thin, that let's face it, if gasoline in the States, let's say, is $4 a gallon and it costs you $80 to fill up your tank, and, gasoline drops to $2 a gallon and it costs you $20 to fill up your tank, or $40 to fill up your tank versus $80. Okay, it's a $40 savings. But really, $40? $40 is $40. Money doesn't grow on trees. But I'm saying, is this economy that poor that $40 makes a difference? If it's that thin, then we're in trouble anyway. And so I never bought that argument. Who doesn't want an extra $40 in their pocket? I'm not minimizing that, but I'm saying that isn't enough to make a difference.
Tim, so with oil and gold still expected to go down, should investors just hold on to their money and wait for that?
I would. Like I said, I think cash is the place to be. And what people don't understand, what people refuse to understand, what people can't, I don't know, maybe they just can't comprehend it. But this is deflation. Deflation. Everybody has been talking about inflation. But the thing is that we're dealing with deflationary forces and have been since 2000. The inflation that has been created by the Fed trying to fight the natural deflationary forces. Guess what? Look who's winning now. The natural forces. They have manipulated, but look at the price of crude oil. Look at the price of gold. Look at all commodities in general. Look at the economy. Deflation is winning. The Fed is losing control. That's what these charts are telling us. And deflation will prevail. Now, they've done one heck of a job at putting it off. I understand that. I'm not trash talking the Fed. I mean, if I was in their shoes, if you were in their shoes, you would probably do the same thing. We probably would both do the same thing to try to prevent the massive washouts. Just human nature to try to do that. But at this point, what my point is that the natural forces are taking hold. I think they're losing the battle, and the Fed's losing the battle. And we're seeing that's what commodities are telling us, and I think that we're about to see that in equities.
Tim, anything else you wanted to add today?
Nope, that's pretty much it.
Put it in cash and wait for the crash.
Put it in cash and wait for the crash. I like that. Under the mattress. I mean, who was it? Was it Jim Rogers? What was the saying he said? You want to be aggressively in cash or something to that point. I can't remember what the quote was, but it was a catchy little quote like that. And I agree with that. I think he's seeing the same thing here.
Tim, thank you very much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on YouTube at Talk Digital Network. Also check us out on Twitter at Talk Digital Net. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.